Life isn't a game, and neither is financial planning. But if it were, what game would you be playing? A game of chance or a game of skill and strategy? I'm Wes Wood, the income guy and founder and president of Wood Financial Group. And for nearly 20 years, I specialize in helping hardworking Tennesseans just like you reach their retirement goals through income-based financial strategies. And if you're looking for the right solutions to achieve your own financial goals, look no further. Just reach out to me at retiretv.com or by calling 855-776-0614 during today's show or at any time. Now, let's talk about games. Some games, like roulette, are almost all about luck. Other games like poker are mostly luck with some strategy involved. Some, like chess, mostly depend on strategy with just a bit of luck involved. So the question is, what game are you playing with your retirement plan? Are you playing retirement roulette, poker, or chess? Which one should you be playing? I think the obvious answer is chess. When it comes to creating a strategy designed to meet your income needs for up to 30 years, you want a strategy based on, well, strategy. And today, we'll explain how the different approaches to retirement planning compare to these three different games: roulette, poker, and chess. We'll also focus on why investing for income is the more strategic option and the most practical for investors in or nearing retirement. Also, joining us again on this week's show is David Scranton. David is a specialist when it comes to investing for income with over 30 years in the business. He's also a best-selling author and a TV host. But before we get to Dave, let's talk more about what it means to be playing retirement roulette. Round and round she goes. Where she stops, nobody knows. But if you put a straight inside bet on 17 black, you're sure hoping she stops there. Roulette can be fun, but it's a game of chance. And if you make that straight bet, your odds of winning it are only 2.63%. Even if you split the bet and take two numbers, your odds only improve to about 5%. Of course, if you do win that straight bet, you get maximum payout. Because in gambling, the bigger the risk, the bigger the return. Now, people assume that's how it works with investing, but it's not always the case. The point is, for most of our working lives, we're kind of sort of playing roulette when it comes to investing. That's because when you're in your 20s and 30s and 40s, you're typically investing for growth in the stock market. And generally speaking, it's more of a gamble than it is a strategy. Now, this isn't necessarily a bad thing for several reasons. First, there is some strategy involved in stock market investing. And typically, your 401k plans and other accounts are investing in a diverse pool of stocks and mutual funds. And these funds and mutual funds are designed to lower your risk and ensure your money grows rather than it shrinks. That's kind of a strategic plan, although it doesn't really give you any control. You're still just betting on probability. The good news is your odds on this bet are quite a bit different than they are on that roulette table. Most people have been told that they can count on getting 9 to 10% from the stock market over a very long run based on market history, and that's fairly accurate. But here's the thing. Market history also tells us that's the very long run, and the very long run is 25 to 30 years. And during that long stretch, the market typically experiences a whole lot of ups and downs. Some of those downs can be big and can last for years. And we saw this from the year 2000 to 2002, and again from 2007 to 2009. The market fell by almost 50% during that first correction and took almost 7 years to recover. Then it was down almost 60% after the financial crisis and took almost 6 years to recover. Now, if you're in your 20s, 30s, or 40s, you had time to wait, and you still had a long time before having to turn that savings on into retirement income. That's why playing investment roulette at that age isn't necessarily a bad thing. But what happens when you hit the age where you no longer have the time to ride out the dips? What if you need to start making your money generate a reliable income within 10 years or 5 years, or maybe you're retired right now? Do you still want to be playing roulette at that point? Or should you switch the game that's based more on a strategy than a chance? And I'll talk a lot more about that later in the show. You can also learn a lot more right now by downloading our retirement income kit. It's absolutely free. by going to retiretv.com or by calling 855-776-0614 to get your free kit. Now, let's bring on our guest, David Scranton. David is the founder of Sound Income Strategies and the founder of the Retirement Income Store. Hey, Dave, thanks for being on our show again this week.
Great to be back again with you, Wes, as usual. You know, we talk about this 30-year long term in the stock market all the time, but that's not typically what your viewers hear from other advisors, though, is it?
Yeah, a lot of times our viewers hear from other advisors that these bull and bear markets, well, the bull markets only last a couple of years. But if you actually look at the stock market over a long period of time, the market can get stuck to where it's basically flat in these what we call secular bear markets, and then we'll have these bull markets. And typically those secular bulls and bears do last quite a long time, but actually the secular bear markets tend to last as many as 15 to 20 years in some cases.
So what you're saying is when you take a secular or a long-term bear market and you put it together with the adjacent secular bull market, that's how you get to 30 years essentially for the market to go full cycle, correct?
That's exactly right. You know, a lot of people look at the market and they say, oh, it averages somewhere between 8 to 10% per year. And that's kind of true over the long term. It does average around 10%, but it's not 10% year over year over year, and we all know that. There's years where the market literally averages zero and stays flat for 15, sometimes 20 years, and where it makes a zero rate of return. And then we have a period of time like the 80s and 90s where the market averaged closer to 15 to 20% per year. So the average is worked out at 8 to 9 to 10%, but it comes in big chunks.
Yeah, it's misleading, right? It's like if I told you that Teresa and I, heck, we run an average of 20 miles a week. You think, oh, great. They're out there, they're running together, whether it's sunny, whether it's raining, it's snow on the ground, doesn't matter. But if I then told you we got to that 20-year average because, you see, Teresa really runs 40 miles a week and I don't get off the sofa, that kind of changes the picture, doesn't it?
That's right. It is an average for your couple for you guys to run 20 miles per week, but what is it, 0 and 40 and an average of 20. But Dave, I know you don't run much, but you do take care of yourself in other ways. But Dave, hey, don't go away, and we're going to talk more later in the show. But coming up after the break, we're going to talk about what it means to be playing retirement poker. I'm Wes Wood. You're watching the Retirement Income Show, and we'll be right back.
Retirement accounts like 401ks and IRAs are great tools to save for retirement. They offer tax advantages to help keep more money in your pocket. But withdrawing money from your accounts can have a huge impact on your tax liability. Take money from the right account at the right time and you could minimize it. But taking money from the wrong account at the wrong time could result in a big tax burden. If you're not sure what you should do with your 401k in retirement, visit retiretv.com to schedule a free, no-obligation conversation with Wes Wood and Wood Financial Group.
I'm David Scranton. During my career, I found that most baby boomers have done a great job growing their retirement savings, yet many don't know how to convert their savings into steady income. And that is why I built the Retirement Income Store, to help hardworking Americans preserve their assets and establish steady streams of income.
If you're 55 or older, please claim our free Retirement Income Kit, chock full of information you need to know to get steady income during your retirement. Call 866-714-7377, online at theretirementincomestore.com.
Hi, I'm Wesley Wood, host of the Retirement Income Show, and I'm founder and president of Wood Financial Group. And we're a local independent financial services company that specializes in creating custom retirement solutions tailored to meet your particular needs.
Visit retiretv.com to learn how we can help you create a customized retirement portfolio.
Welcome back. I'm Wes Wood, the Income Guy, and today we're asking the question, are you playing retirement roulette, poker, or chess? So far we covered the riskiest game of retirement roulette. Now let's ante up for a little bit of poker. We all know that one poker player who can bluff their way to winning the pot. It seems like game after game after game. They're a good player, and there's definitely some elements of skill and strategy involved when it comes to poker, like patience and discipline and the ability for someone to read cards and your opponents. In short, you've got to know when to hold them and you got to know when to fold them. Many would even argue that poker is more of a game of skill than it is in chance. But the fact is, chance does play a major role, because every time that deck is shuffled and the cards are dealt, you have no control what hand you end up with. Sure, it could be a full house, but you could also end up with no hand at all. And how does this equate to investing? How might you be playing retirement poker? Well, you're playing retirement poker if you're trusting a plan that gives you far less control than you think it does. Let's say, for instance, you're 5 years away from retirement, and your plan goes a little something like this. You have all your savings in stocks and stock mutual funds, and you're going to keep investing for that 8% growth for the next 5 years. Then, as soon as you retire, you're going to change your investment strategy to invest for 4% income. If that sounds familiar, that's because I've used that analogy once before. But it's a perfect example of someone unknowingly playing retirement poker. Why? Because your so-called strategy requires you to bet on the big unknown, just like you do every time you ante up or raise at the poker table. The unknown, of course, is whether or not you're going to get that 8% growth. That's like spinning the roulette wheel or reshuffling that card game and not too sure what kind of hand you're going to get. You might get your 8%, but it's still a gamble. Anytime you invest for growth in the stock market, you're ultimately just betting on probability. That's what makes it much more of a gamble than it is a strategy, even when you think you're being strategic. I know what you're saying. You're saying, okay, Wes, I hear what you're saying, but what about all those champion poker players out there? And what about those big investors like Warren Buffett who never seem to miss? Well, I'm glad you thought that, and I'm glad you asked. High-stakes poker is a lot different from your Tuesday night game with the boys. But by the same token, the same kind of investing Warren Buffett does is a lot different than the kind of investing that we would do. When Warren Buffett invests in a company, he typically buys a controlling share. That gives him a level of control over the company's fate. When you or I invest, we're usually buying a minority interest, which does not give us that type of control. We're putting our money into the companies in a mere hope that it succeeds. Think of it like FanDuel, the popular betting website. If you place a bet in FanDuel and you bet on the, let's say, Tennessee Titans to win, you and our coach, Mike Vrabel, now have something in common. We both want the Titans to win. But Mike Vrabel has some control over what happens in this situation, who wins the game, where you don't. You might say he's truly invested in the team while you're just betting on the team. No financial strategy gives you complete control, and no investment is 100% risk-free. But a more truly strategic, the way you can be with your investments within 10 years of retirement, the better you're going to be in the long run. And that's where retirement chess comes in. Now, we can help you create a retirement chess plan at Wood Financial Group. Reach out to me directly at retiretv.com or by calling 855-776-0614. Now, let's welcome back Investing for Income Specialist, David Scranton. Welcome back, Dave.
Thanks. Well, you know, it's interesting because I could almost hear your viewers right through the television set thinking, okay, Wes, I get it. I don't have control when I invest in the stock market. But over the long run, the stock market still goes up, right?
Mm-hmm. Well, it does, but remember what I mentioned before the break there. We have these time periods where the market can stay flat and does stay flat for many years in the road, many years down the line. You know, a lot of analysts say, well, the market only corrects and stays corrected for a couple of years, and that's kind of true, but in essence, the market actually can stay flat for many years, and that's what's called the secular bear market. Not cyclical, secular. And if somebody's close to or in retirement and happens to go through, let's just say, 2013, when the market was essentially flat with two major crashes, and that's happened many times in stock market history, that's when problems can happen.
Well, like what, 2000 to 2013, right? Just at the beginning of the century, and most of your viewers remember that period. 13 years underwater. That's a long time.
Oh yeah, absolutely. And just like go back to 1966 to 82.
Yeah.
The Dow Jones hit 1,000 one day on 1966, and then the Dow Jones in 1982 hit 1,000 as well. That's a long-term secular bear market that can really upset retirees.
Yeah, you know, so it's interesting. I've heard you say before, and I think it's worth taking a minute, if you don't mind, to explain to your audience. Before, when I've heard you talking about how, as average investors who aren't Warren Buffett, who don't own a controlling interest, how essentially we're overpaying for shares of stock every day of our lives.
Yeah, well, when Warren Buffett buys a controlling interest of a company, you think that maybe he's paying 50 to 100% above market value, but we all know that's not true. Probably paying more like 10 to 15, maybe upwards of 20% when he buys control of the company. But again, he's a lot like that head coach of the football team, where now he has control of the company and he's got a much more likely outcome. Whereas us, as minority investors, we're just simply betting on the team, just hoping that this stock or this company does well. So what ends up happening is we end up definitely paying a lot more for the shares. And when the market gets kind of bad or wild, and guess who's going to be holding the bag? Do you think it's going to be the big Wall Street firms, or to listeners just on the other side of this television screen who's following us right now?
So you don't think that Warren Buffett is negotiating such a great deal with market participants that he's underpaying? You think the reality is that minority investors essentially, and I say minority investors, I mean those that don't have controlling interest, are essentially overpaying every day?
That's exactly right, Dave. Yep.
Yeah. And you're not anti-stock. You're just, for people 50 and over, anti-growth. You could be in the stock market providing your income first and growth second in terms of your philosophy, correct?
That's exactly right. Taking that stance, that priority of income first and then growth second. But by doing that, it limits the risk, but then we know that the income is more certain and we can count on it. Where somebody that is younger, yes, they can probably take more in growth and buy the Apples and Amazons of the world. But if somebody gets within that 10 years or so retirement, they really need to make that shift from growth to income, and still can do it with some money in the stock market, just use more dividend-based strategies. But thanks again, Dave. And coming back after the break, we're going to set up the board for a game of retirement chess. I'm Wes Wood, and you're watching the Retirement Income Show. We'll be right back.
A fiduciary is someone legally obligated to act in your best interest. Doctors, lawyers, and some financial advisors are fiduciaries, but not all. When you work with Wes Wood and his team at Wood Financial Group, you are working with fiduciaries. They help clients create customized investment portfolios based off their retirement goals. If you're ready to work with a fiduciary, visit retiretv.com and schedule a free, no-obligation conversation with Wes or a Wood Financial Group advisor.
Welcome back. I'm Wes Wood, the Income Guy. Thanks for joining me. So far, we talked about what it means to be playing retirement roulette and poker with your retirement plan. Now, let's focus on the most strategic option by far, retirement chess. The book, Modern Chess Openings, was first published in 1911, and to this day remains as the go-to guide for learning the game. In other words, chess is a strategic game from the very first move. Is there an element of chance involved? Sure. But if you make a bad move and your opponent doesn't catch it, you've lucked out. You can undo the error, and on your very next move, you can regain your advantage. But compared to poker and roulette, chess is by far the most strategic game. And when it comes to creating a plan to achieve your retirement goals, you want one that leaves very little to chance. You want to work with the right advisor to create a true retirement strategy. You want an approach that's actively managed and puts you on a path to victory from the opening move. In other words, you want to be playing retirement chess. And once you make your shift from a strategic focus from growth to now income, you are. And here's why. In chess, you have clearly defined goals to capture your opponent's king and to protect your own. You work towards those goals from the opening move with a strategy that is equal parts offense and defense. You manage and modify your strategy throughout the middle game and the end game, always looking ahead. By the same token, investing for income starts with clearly defining your retirement goals. From there, you work with an income specialist to create and manage a plan to achieve them. It's also a strategy that is in equal parts offense and defense. It's designed to protect your savings, generate income, and allow you to grow your portfolio organically. Let's take an example that I used earlier. You have all your money in stocks and your plan is to keep investing for growth over the next 5 years until you retire. Then after that, once you've retired, you change your strategy to invest for 4% income. But as I pointed out, that approach is more like playing poker because it requires you to invest in the big unknown. And the unknown is whether or not the stock market will deliver that 8% growth. But what if you start investing for income right now, 5 years before retirement? Well, in that case, you're no longer betting on the big unknown. Instead, you're creating a strategy based on things you do know. You know that bond and bond-like instruments in your portfolio are less vulnerable to market volatility than growth stocks are. You can count on them to generate at least 3 to 4% in income return in the form of interest and dividends. And since you're still probably working and don't need that income yet, you can know that you can reinvest those interest and dividends and keep growing your portfolio. And if the stock market happens to take that plunge, well, now you have the option to get back in at bargain prices and potentially increase your dividend income. The point is, when you invest for income, you have an approach that doesn't depend on just the lucky spin of the wheel. You have a true strategy based on clearly defined goals and making smart moves from the very opening. Make your opening move right now, the right move, and reach out to me directly at retiretv.com or by calling me at 855-776-064 and request your free retirement income kit. Now, let's welcome back income specialist and founder of the Retirement Income Store, David Scranton. Welcome back, Dave.
Thanks, Wes. You know, it's interesting. Just a moment ago, you said staying in growth too long, too close to retirement is kind of like playing poker. I actually think it's more like playing roulette because you never know where the markets are going to be when you want to retire. And going to an income approach in the stock market, higher dividend stocks, might be more like playing poker. But I've heard you say in the past that really, in many ways, the true chess game is focusing on things that are members of that thing you call bonds and bond-like instruments. So Can you explain for just a moment how that is really more of the chess side of it versus high dividend common stocks?
Yeah, absolutely. Well, when you invest in bond and bond-like instruments, you're investing in more of a contract-based vehicles, meaning you know that, hey, if you hold this bond or this type of bond-like instrument until maturity, not only do you get the par value back, but you collect an interest or dividend along the way that's set. But when the market does happen to drop, which we all know it will at some point, then you can be a capitalist, meaning you could maybe exit some of those bond and bond-like instruments, buy back into the market when it's much lower. And the way to really make money in the market isn't just to ride it out in growth-like positions, it's more take advantage of when the market's down in value. So that's a great place to start, is maybe investing more conservatively and know when to maybe jump in when the market's down.
Well, the other alternative to being a capitalist is being a victim, right? The market drops and you say, woe is me, I'm down on paper, there's nothing I can do about it. So call me crazy, I'll take the capitalist side of it over the victim side any day, right?
Yeah, that's exactly right. And you know, a lot of folks that are in my industry and in our industry for that matter, really just focus more on the growth world. And they think, well, heck, if the market's going up, the answer is we'll ride it out. If the market's high, then you just stick it out. If the market's going down, you stick it out. If the market's low, you stick it out. For folks that may work for folks that are younger in their 20s and 30s that aren't going to touch their money for 30, 40 years for that matter, whenever they do retire. But for folks that are close to or into retirement, they really need to play this game of chess and get it right from the very beginning.
And realistically, what kind of interest rate can people earn today in this universe of bonds and bond-like instruments in your experience?
4+ % is what we're seeing in the world of these bond and bond-like instruments in income.
But yeah, okay, that's great. But you talk to your average broker, your average advisor, and they're going to say to their clients, maybe you can earn 2% if you're lucky. So what's the difference?
Well, Dave, I think it really comes down to their business model. They just don't know how or understand the right way to invest for income. You know, there's a lot of different types of investors out there and investment advisors out there, and many of them in our industry focus more on the Wall Street types of growth types of investments, and are not specialists when it comes to income, and so they just don't know how to invest it properly.
Final thoughts for your loyal viewers in Nashville.
Yeah. I'd say the number one thing to know is that you need to know when the right time to make the shift from growth to income. And the sooner, the better to do it, especially if you're dialing into those retirement years, 5 to 10 years or so out, knowing when to make that shift and to do it at the right time, which again is during those very important transitional years, timing. Thanks, Dave. And for next week, please join us again, and thank you for checking in on this episode of the Retirement Income Show. I'm Wes Wood, the Income Guy. You've been watching us, and I really appreciate you. And please reach out to us and me at retiretv.com or by calling 855-776-0614. Be sure to tune in next week. Hi, I'm Wesley Wood, host of the Retirement Income Show, and I'm founder and president of Wood Financial Group. And we're a local independent financial services company that specializes in creating custom retirement solutions tailored to meet your particular needs.
Visit retiretv.com to learn how we can help you create a customized retirement portfolio.